Imagine a world where the most powerful force shaping human civilization, more influential than kings, armies, or even natural disasters, is something we can't hold, taste, or truly see. It is, in fact, an abstract, ephemeral concept built entirely on trust, money. Not the coins or the paper, but the complex, ever-mutating system of credit and debt, risk and return that underpins every moment of our lives. From the price of your morning coffee to the stability of nations, the hidden architecture of finance dictates the rhythm of the world. To understand this architecture is not just to understand economics, it is to unlock the essential backstory behind all history. The Ascent of an Idea. Niall Ferguson's masterpiece, The Ascent of Money, A Financial History of the World, is a profound invitation to look past the political and military dramas that dominate history books and to see the world through the lens of finance. It argues compellingly that financial innovation has been as vital to human progress as any scientific or technological breakthrough. Indeed, the ascent of mankind is inextricably linked to the ascent of money. The story of civilization is, at its core, the story of how we learn to manage risk, create capital, and channel ambition through increasingly sophisticated financial institutions. The narrative begins not in Wall Street or the City of London, but in ancient Mesopotamia, where clay tablets recorded the first rudimentary forms of credit. This initial step, the ability to record a debt, to create a promise to pay, was a moment of profound genius. It allowed economic life to move beyond simple barter and laid the foundation for all future financial structures. This simple leap of faith, the trust that a future obligation will be honored, is the bedrock upon which the entire global financial system rests. The 6 Killer Apps of Finance. Ferguson structures his history by examining the evolution of what one might call the 6 killer apps of modern finance, each a critical innovation that solved a specific economic problem. 1. Banking and credit, bridging time. The transition from mere debt records to formal banks was the next great evolutionary jump. Traced from the goldsmiths of medieval Europe to the powerful Medici family in Renaissance Florence, banks solved the critical problem of liquidity and maturity transformation. They took short-term small savings and transformed them into long-term large loans, enabling merchants, industrialists, and even popes to undertake ventures far exceeding their immediate capital. The bank became the ultimate financial intermediary, proving that the absence of a formal financial sector is a far more potent creator of poverty than its presence is of greed. 2. Bonds, the sinews of war. The bond market, born largely out of the necessity of warfare in Renaissance Italy, solved the problem of long-term public finance. When Venice or Florence needed to fund a protracted conflict, a new mechanism was required, a tradable promise by the state to repay a loan with interest over a defined period. The development of permanent liquid markets for government debt proved to be the sinews of war. Great powers, most notably Great Britain, discovered that fiscal credibility, the reliable servicing of their debts, was a more decisive military advantage than larger armies. The ability to borrow cheaply, facilitated by the deep liquidity of the bond market, allowed Britain to consistently outspend and ultimately defeat rivals like Napoleonic France, whose financial systems were less sophisticated and more prone to default. 3. Stocks, democratizing risk and opportunity. The creation of the stock market and the joint stock company solved the problem of pooling capital for large, risky ventures. Early examples, such as the Dutch East India Company, allowed thousands of ordinary citizens to own a piece of a distant, ambitious enterprise. Crucially, the transferable share democratized both opportunity and risk. No single investor had to bear the full cost of a shipwreck or a failed colony. This ability to diversify risk across a large number of investors fueled the age of exploration and later, the Industrial Revolution. It also introduced the concept of the speculative bubble, from the notorious Mississippi bubble in 18th century France to the tulip mania in Holland, a stark reminder that the financial system is indeed a mirror, reflecting not just our rational self-interest, but also our profound collective madness and irrational exuberance. 4. Insurance, mitigating catastrophe. Life is inherently uncertain, and so the next great invention was insurance, a mechanism for managing catastrophic, non-diversifiable risk. From the earliest forms of marine insurance among London merchants to the development of life assurance by Scottish ministers seeking to provide for their brethren's families, Insurance is the technology that sells peace of mind. By allowing individuals and businesses to pay a small certain premium to protect against a large uncertain loss, it liberates capital for productive use. This concept eventually extended to public finance in the form of the welfare state and Social Security, an attempt to ensure citizens against the catastrophic risks of poverty, old age, and sickness, an endeavor with its own set of financial complexities and looming solvency crises. 5. Real estate finance, the cult of homeownership. Real estate finance, particularly the mortgage, solved the problem of illiquidity in the single largest asset category for most families, the home. The development of the standardized long-term mortgage allowed vast swaths of the population to move from being renters to owners, turning their illiquid physical asset into a source of leverageable capital. This process has profound social and political implications, but as Ferguson meticulously details, it is also a system perpetually prone to crises. The phrase "safe as houses" proved tragically ironic in the 2008 subprime mortgage crisis, which originated in the reckless securitization of American home loans and quickly spread like a virus across the globe, demonstrating the profound interconnectedness of planet finance. 6. Derivatives and global finance, the new frontier. Finally, the evolution of derivatives and global finance, epitomized by hedge funds and the complex instruments of modern Wall Street, represents the latest, most abstract stage of money's ascent. These tools, contracts whose value is derived from an underlying asset, are designed to manage, package, and trade risk in ever more sophisticated ways. They are the epitome of financial evolution, incredibly complex, highly specialized, and capable of generating immense wealth or precipitating spectacular collapse. They underscore Ferguson's key message: the financial world is a dynamic, evolutionary ecosystem where innovations lead to periods of rapid growth, which are inevitably punctuated by extinctions, the crashes and crises that prune the system and force adaptation. The Great Intertwinement Chimerica. In the modern context, Ferguson introduces the concept of chimerica, the symbiotic economic entity formed by the United States, the great consumer and borrower, and China, the great producer and lender. This relationship, a contemporary fusion of the historical dynamics between debtors and creditors, fueled an unprecedented wave of globalization and growth. The American appetite for debt was perfectly matched by China's insatiable accumulation of dollar reserves, a dynamic that kept interest rates low and cheap goods flowing. However, as all of history demonstrates, financial symbiosis can quickly descend into systemic fragility. The global financial crisis of 2008 served as a jarring reminder that the evolutionary progress of finance is never smooth. Every bubble bursts, not because of a sudden failure of mathematics, but because of a perennial failure of human nature. Greed flips to fear. Optimism transforms into panic. The final lesson: history as a warning. The ultimate lesson of the Ascent of Money is not one of condemnation, but of recognition. We may often feel hostility towards the financial system, resenting the plutocrats and the arcane complexity of global markets. Yet we ignore the history of finance at our peril. It is a history that proves the necessity of a functioning financial ecosystem for the eradication of poverty and the sustained growth of human flourishing. Societies that have developed strong formal financial institutions have invariably prospered at the expense of those that remained financially primitive. Access to credit, insurance, and diversified investment is the most effective lever for lifting populations out of destitution. However, the history also serves as a crucial warning. Because the financial system is a mirror of mankind, it reflects our inherent flaws, our tendency towards irrational herd behavior, our capacity for reckless speculation, and our recurring inability to heed the warnings of the past. From the 17th century South Sea bubble to the 21st century cryptocurrency craze, the pattern remains chillingly consistent. Financial innovation is invariably followed by financial excess, followed by financial disaster.